We're managing an emerging market long-only equity strategy. It's 100% invested. We invest in publicly traded stocks throughout the emerging market, frontier market world. Our focus really is on understanding the macro risk, and we believe that understanding macro risk is important because you have currency risk, currency volatility, interest rate risk, geopolitical risk. So it's very hard to be just a bottom-up stock picker in emerging markets. You could find the best company, best management, cheap valuations, yet if the currency depreciates 30–40%, you're going to lose a lot of money. We also believe that we want to identify growth themes. We are a thematic investor in trying to identify these growth opportunities globally. Some of the themes might be emerging market travel, infrastructure. Some of the themes might be driven by technology changes, such as artificial intelligence, such as the electric vehicle. And so both the macro and the thematic go into us trying to find the best stocks to build a portfolio on a diversified basis of 50 to 60 names. Well, first of all, we are growth investors, so we want to find growth opportunities. We're not buying stocks just because they're cheap. But where we differ from a traditional growth manager is that we don't want to pay any price for that growth. We are growth at a reasonable price, but the number one characteristic is there has to be top-line growth that translates into bottom-line growth. And then we look at basically PE multiples, EV/EBITDA multiples, as well as discounted cash flow models in terms of finding that valuation. Currently, our portfolio trades at about 12 times earnings, which compared to the benchmark is about 10 times earnings. But the growth rate of our companies from a bottoms-up basis is north of 20%, whereas the index is growing at around 10%. So for a slight premium, we're able to basically find companies that grow at over twice the level of the index. One of our larger holdings is Sberbank. Sberbank is the largest bank in Russia. They pretty much dominate and continue to take market share as that basically market becomes more centralized, more consolidated. Sberbank, the stock currently trades at about 4.5 times earnings, which is a very, very cheap valuation for a business that's growing at 12 to 13% over time. This bank also has a return on equity that's been north of 20%, despite the relatively slow growth in Russia. And so we think there's tremendous upside in the valuation. Corporate governance actually is improving. It is an SOE, but management actually is compensated by stock. That's very rare for SOEs. In addition, they're compensated by the metrics of the bank overall. They're very much trying to increase and use technology to grow financial services. Even metrics like mortgages to GDP are very, very low in a place like Russia at 9–10% compared to 30–40% in other markets. Another company that we own is Minor International. Minor International is a Thailand-based hotel operator, and they have over 100,000 rooms throughout Asia. They operate hotel chains like the Four Seasons, great properties. They also have their own brands, which are mid-level to high-level, and they also have food and beverage assets throughout the emerging world. This company basically trades at about 15 times earnings, but over time has been north of 20% grower. Very strong growth. It fits into our emerging market travel theme, and as these economies basically, as GDP per capita increases, they basically have disposable income to now think about traveling domestically, but also think about traveling internationally. Thailand actually has 35 million people visiting that country every year, and about a third of those are Chinese. And that the Chinese visitation is growing at anywhere from 50 to as high as 70% per year. So very, very big opportunity in terms of that emerging market travel theme. We believe that on-the-ground research is really important. So we have an 18-person investment team located in three offices. Our team speaks the local language. They grew up in these markets. They travel to these markets often, probably either every quarter, every other quarter. So kicking the tires on the ground, meeting with not only the company, but their competitors, meeting with government officials, talking to people on the street, we believe is really important. I travel quite often. I'm probably on the road 25 to 35% of the time. I do travel with my analysts and parts of our team, so we believe that that's important, encouraging travel together. So again, we travel quite often. We believe that ESG is important. We don't claim to be ESG managers, but we do believe that it's an important part of the due diligence process. You should be asking questions around governance, social issues, environmental issues. So since inception, since we started this strategy 6 years ago, we put in an ESG scoring system that we were developed in-house. It's our own proprietary model. But in addition to that, we have other tools. We do vote actively using ISS, so we do engage with management teams. We do vote against management if we don't believe that the board is moving in the right direction. And in addition, we use Sustainalytics. Sustainalytics is another tool in terms of analyzing the governance of a company, looking at basically social issues, looking at environmental risks. So we do believe that ESG is important. We believe that understanding the culture of a company, understanding the culture of a board and the CEO and what direction they want to take that company in can minimize the risk. And some of those factors obviously are picked up when we score the company with our internal model.